to the loan officer training series with the mortgage calculator. We'll get started in just a minute. Just waiting to go live on all the different platforms here. We are streaming live on YouTube and Facebook and Instagram and LinkedIn. So give us a second to go live and then we will get into it. Thank you everybody for commenting already, even before we jumped on. Feel free to drop a comment there as you hop on, and we will get started shortly. Today, we're going to expand on what we were talking about yesterday. So, for those of you that joined us yesterday, we'll pick that up. And those of you who didn't join us yesterday, you can still watch this. It's still going to be applicable. And you could also go back and watch yesterday on our YouTube channel as well for yesterday's training on DPA programs. All right, looks like we are live on all the different platforms, so we can go ahead and get started here. Welcome, everyone. My name is Kyle Hershey. I'm the CEO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And every Tuesday and Wednesday, we do our loan officer training series here at 7 p.m. Eastern, where we go through some different training topics. Yesterday's topic was DPA, down payment assistance programs. And tonight, we're going to pick up kind of part two and do a little deeper dive into that here. So, Jose Gonzalez, our sales manager, 27 years as a loan officer and a realtor, is going to take us through essentially part two of our down payment assistance program training. So, Jose, you want to go ahead and take it from there?
Absolutely. Good evening, everybody. Thank you for joining us for our loan officer training. This is where I'm going to go into the meat and potatoes of DPA, right? We're actually going to go over some quote scenarios, some pricing scenarios, and then I'm going to discuss a little break-even points for you so you can see what I was mentioning yesterday as to why we would use one option over the other. Now, to refresh everyone's memory regarding what I just mentioned right now, you know that we have three different options in this down payment assistance program that we're offering. The first option is the forgivable option, right? That one has a minimum credit score of 620, and there's no payments that are due on the second loan, right? There's no payment and there's no interest that accrues either. There is a lien placed on the property for the amount of the loan, of course. And the beauty of this program is that as long as the borrower is current on the loan, right, you've been making your timely payments and you're current after the 60th loan payment, after the 60th month, 60, the loan is forgiven. Uh, so if it's not forgiven, otherwise it's going to stay on the property still. No interest is accruing, but it is an additional lien that would have to get satisfied uh, when the property is sold. Another catch to the program, in order for it to be forgivable, is that the property has to be owner occupied during those first 5 years as well, in order for it to be forgiven. So if you have to move out of the house for whatever reason, they're not going to forgive the loan, right? So the other option that we have, second option that we have, is the repayable option, which is a second mortgage at 9.99% interest, amortized over 30 years, but with a balloon payment due at the end of 10 years. So, again, there is a payment due on that. The benefit to this program is that the interest rate is lower than the forgivable option. It does require, though, a little bit higher credit score, minimum 660. excuse me, minimum 660 on the score. Uh, but it is a little bit more forgiving as far as the DTI can go to 50%. Um, Whereas on the forgivable option, the DTI can go to 50%, but um, if you're a first time home buyer, it's capped at 43%, and then you have to complete a home buyer education course if you need to go above 43%. Keep in mind also on any of these programs, they are subject to FHA guidelines. So if a manual underwrite is required on the loan because you did not receive your automated approval, that's subject to 43% DTI on that option. And the third option that we have, which is actually could be considered multiple options because you can go 3%, 4%, 5% on closing cost assistance, is what they call this one, where it requires a minimum 3.5% uh, monetary contribution from the buyer into the transaction, which just happens to equal the FHA minimum down payment, but it does allow higher percentage of assistance, right? Whereas the first two options are 3.5% assistance, this one's 3%, 4%, and 5%, even though they list 6%. I wasn't able to find the 6% assistance on their rate sheet, current rate sheet on there. So maybe they took that option off and they just haven't updated their terms and the guidelines. So let me share some of the uh, info that I have for you, so you can see. Now, what I have done here in these examples is that I have the pricing at 45 days. You know, trying to give a little extra time for the extra processing that may be required for the second mortgage. So in our forgivable option here, though, I am assuming a 660 credit score for the pricing. For again, 45 day pricing here. And as I mentioned yesterday, um, I, I mean, they do offer lender paid comp. I mean, obviously you can buy the rate down, and then you're going to have a discount fee to pay. But here I try to offer, in all the examples I'm offering today, I try to offer the lowest cost option because typically a borrower that's contemplating the down payment assistance may be a little tight on the funds and may not be looking to pay extra monies to buy the rate down. But if you are looking to buy the rate down, you're probably looking at there's really it's not much of a benefit actually when I'm looking at the rate sheet, because once you go down 1 or 2 eighth of a percent, it like the cost increases prohibitively. Like it costs to go down to the next 0.125 below the rate that I'm quoting there, it costs 2 points. So it doesn't really make sense to pay 2 points to save, a couple dollars a month. So in this example here, for this option, 8.25% rate will actually give you a lender credit of $866. Now, this is for a $450,000 purchase and a $434,250 loan amount. So our monthly payment there does not include escrows for taxes, insurance, no mortgage insurance. I'm just trying to compare apples to apples here when we're going to be analyzing the different payment amounts within our different examples, so we can see and be better able to explain these different options when explaining this DPA program to your prospects. So you see $3,319 as a monthly payment and a lender credit of $866, which is very important because that is used also towards the buyer's closing costs. So it's like a little extra spiff that is being thrown in there. So here, the assistance is equal to 3.5% of the purchase price. So here, the assistance is $15,750. So you could use that for whatever you're going to use that in the transaction, but that could be equal almost to their closing costs, depending on what part of the country you're in, insurance expenses, escrow, that kind of stuff. And as I noted, again, no payment due, and the loan is forgiven after 60 payments are made on the first. So keep in mind our payment there, 33.19, right? So now in our second option here is the repayable DPA FHA purchase. Again, 3.5% assistance with a 660 credit score, 45-day pricing here. Uh, so the 7.5% now is the rate. So you do notice that the rate is 0.75 of a percent lower than on the forgivable option. So that's where you're going to see the benefit that I was mentioning yesterday as to why would a borrower choose the 8.25 or choose the forgivable versus the repayable option. And you can see right here, what if your buyer is close to the 50% DTI, right? And they don't qualify at the 8.25% rate. You may have to go to the 7.5% rate to have them qualify. Because there is a $230 difference in the payment. The cost is the same. You're going to get the same lender credit of $866 on this loan amount on this program, which is very good. You'll notice though, with your payment being $3,089, which is $230 lower, your break-even point. This is what I was alluding to yesterday. Your break-even point on that benefit of $15,750 that you receive on the forgivable option is 68.47 months. So it's basically 68 and a half months. So that would be 5 years and 8.5 months. So you see why they got that 5 year period down, right? They have an idea of where they're coming from on that forgivable part. But still, with the break even point at 5 years and 8.5 months, that means if your loan is active for longer than that, you are ahead on this program than you were on the other one. And then every payment that you make is just that much more that you're ahead, because it's $230. So after 5 years, 8 months, and 2 weeks, you're going to be benefiting from that $230 per month lower payment to put you in the black on this program versus the individual that received the forgivable option and may be staying in that loan at that 8.25% rate. So again, you
So
see
what does
here.
that actually mean, Jose? If someone is going to refinance before when, which one do they want to choose?
Well, if someone is going, well, here again, you got to look at the requirements. On the forgivable one, you have to be there at least 5 years, right? So if you would be in a position to be able to refinance financially, if your income is going to be good and your credit is going to be good, that's always a chance we take. And we would hope that the rates would be, lower than they are now. If we're talking about doing the loan right now in this current environment of interest rates, the rates I would probably forecast should be lower 5 years from now if we follow the cycle, the economic cycles, and how things work in the money trail. You would be looking at probably wanting to do the forgivable option if you plan on staying in that property for the 60 months. And then once it's forgiven, on month number 61 or 62, you would probably want to initiate a refinance of the property to refinance into a lower loan. Now, mind you, you are going to incur some transaction expenses there from the refinance. Those you can finance into the deal. So you got to really analyze that part of the transaction as well. But if we're just looking at the payment wise, at that point, you would be able to refinance, hopefully into a lower rate, maybe 5, 4, 4.5. You never know where we may be in 5 years, but I think it'll probably be lower than 8.25%, which is what that program would be able to offer today. But if you don't refinance, and then the individual that used the repayable option is going to be paying $250 a month lower than you are, you've already exhausted your benefit at that point that you received, because your payment is $230 a month higher. So now with every payment you make, you could be thinking, I could have had a lower payment. So it's really there. Obviously,
So there's a short window where the forgivable makes sense.
yeah,
Between
yes,
they'd have to refinance between month 60 and 68.4
yeah, yeah.
for the forgivable to make sense.
To
Correct?
be ahead of the game
On the
of the
repairable.
repayable option, correct? Because it's the break even point is 68.47 a
and
month.
and and neither would want to do it before 5 years because that triggers extra penalties and whatnot usually on the
Well, on the I'm not sure if there's any penalty on the repayable option. And actually, what you have to consider on the repayable option is that at some point you're going to have to take some action, because it's a balloon payment due in 10 years, right? So at the end of 10
so
years
between 68 and
and
what
120,
120 you got to
you
make do
you
something.
yeah, you better hope the rates don't skyrocket at that point. So at that point, that would be a good time for the loan originator to be touch and base with the borrower. Hopefully, you still have them in your sphere. Reach out to them and nudge them and let them know, hey, Mr. and Mrs. Borrower, remember you got a balloon there. Rates are good right now. Maybe you may want to refinance the whole deal. And at this point, you can really do that at any time with this borrower, when the rates may take a dip from 7.5 maybe to 5.5. And then you could reach out and say, hey, you know what, let's just refinance everything into one loan. You have some increased equity now. The rate's 5.5, better than 7.5 plus the 9.99 that they're paying, which by the way is $141 a month. So lot of different ways here that you could stay in touch with the customer and make sure that you add value to the relationship by reminding him, or her, of what's going on, to make sure that they don't fall asleep at the wheel, and then all of a sudden they're looking at a balloon, maybe at a time when rates could be higher, or maybe they may not be financially able to refinance, and then they're going to be in trouble, because we always assume we're not going to have any problems with credit and income, health, and all these things, but those things can change really quickly. So this is DPA repayable, right? So now I got a couple more examples here. Now this is the closing cost assistance program. Now this program, uh, the real benefit here is going to be, if you, not so much I think for the 3% one, but for the 4 and the 5% assistance option. If you're going to need it, right? It all depends what you need. Maybe you don't need the 3.5% that the other option offers. You're good with 3%, a little less money, right? On that second mortgage, you're going to have a little bit lower payment. In this example, if it's 3%, you're looking at $13,500 in closing cost assistance, which is quite a bit of money. Now, this program does have a minimum contribution from the borrower into the deal of 3.5%, which just happens to equal the minimum down payment for an FHA loan, right? I think they sort of planned it that way, right? But you're looking at here a payment of $120. So your payment would be $21 lower than the other one, because you got less money, right? It's less. You're looking at 15,750 versus 13,500. But there is a but here. This is why I try to figure out, why else would someone want this program? because this program actually has a higher rate or a higher cost. Uh, this is the highest rate that they offer. So after factoring in the deal, you're looking at the borrower having to pay $5,068 for this example due to the loan discount. Excuse me, due to the loan discount that is required at this rate. So in order to get the full comp on the deal, you're looking at a loan discount here of $5,068, which is like I can't remember the exact number. I think it was 1.125 or something like that in cost. So, I mean, I'm going to pop back a minute to the other one where you're looking at an $866 lender credit to a 5,000 and change cost. That's a $6,000 swing. So if you're really analyzing what's going on here, right, I don't know if I see the reason to choose this option because, frankly, when you consider that $6,000 swing, that's a like 1.3% difference. So you're really not getting 3%. You're getting net 1.7, 1.8% when you compare this program to the other one that has a little bit of a lender credit, right? But, it's there for those people that think like they may want the lower loan amount is what I'm thinking this boils down to. And my last example here is the 4%, and I'll give you the rate on the 5%. I just didn't have a chance to put it into the presentation here, but at the 4% assistance, you'll note that the rate is the same, but now look at the price of 72.77. That's almost a 0.5% higher than the example at 3%. So you get an extra 1% of closing cost assistance, but with the extra costs associated with it, it really becomes 3.5% of closing cost assistance repayable, which is the same as the 3.5% repayable option that has an $866 lender credit. So again, I'm trying to see the logic of why we would do this, but again, we do have a lower payment, right? So I do have some information there on the break even, but at this point, really, the break even is probably you would have to take some other factors into consideration here, like the extra cost associated. So I think that I would probably have to adjust that 51.64 months to take into consideration the extra cost in loan discount that you're going to suffer. I probably would have to put that into the mix into the $305 a month payment. So you do get 4% closing cost assistance, which is nice. Looks nice in net there, but isn't necessarily, the paint the real picture. And as far as the 5% closing cost assistance, I don't know who would need that much closing cost assistance because 4%, you're already at $18,000. And remember, you already have to give 3.5% minimum contribution from the borrower, right? So essentially, you're giving the minimum down payment. You're using this to actually pay the closing costs. So I don't know too many cases where the closing costs are going to be higher than $18,000, $19,000, unless you're in a high tax and high insurance cost area where the cost of insurance and the cost of the prepaid expenses for taxes and insurance are going to be a sizable chunk of the transaction in areas like Southeast Florida, which is my home market, where a typical 1,500 square foot single family home that's not brand new with brand new roof and brand new windows would probably be paying $4,000 to $5,000 a year in insurance and probably be paying $5,000 to $7,000 a year in taxes, compared to some other markets where you could be paying $2,000 in taxes and $1,000 in insurance. So if you're not in that type of a high cost tax and insurance market, you may not really need this one. Now, the 5% option has even a higher cost. The 5% option has a cost of 2.25 points. So if you factor that in there, you're looking at like $10,000 almost
So
for
wait. To get one more point, you pay
yeah,
how many more points?
yeah, yeah. It's like almost in a whole additional point. Like if I'm looking
So to
here,
get one more point of help, you have to pay one more point in cost.
okay, I'm gonna give you the exact number here because I just popped open the rate sheet. Uh, so I'll do a quick little math. Yeah, it was 1.647 points is the cost for the 4% option, right? So 1.647, and then doing some quick math here for this option. And mind you, this is all using 45-day pricing. It costs 2.272 points. So that's like zero point 0.6 more points to get 1% more. So you're going to get like a net benefit of zero point 0.4 points. That doesn't really make sense to me. I don't know.
Let alone the break even stuff, right?
Yeah, yeah. So I don't really know if that makes sense. I would I like illustrating this more just so that we can concentrate then on the forgivable or the repayable option and just use this one as a selling tool to do one or the other of those others. I mean, I would imagine maybe there's a scenario where this option is possible. I would probably have to dig deeper into the guidelines and see if there's some little loophole workaround that makes this one usable where the other ones are not. I didn't find it yet. Um, but what I would also like to state
Well, I think
another.
what they want you to do is use it for buy downs and points if you need to use it for buy downs and points because you can't use the
Yeah,
DPA if it's down payment for buy downs and points, I guess.
that is what it boils down to actually, because as I'm looking at the rate sheet on the DPA, one where it's either forgivable or repayable, they don't really have options to be able to benefit from buying down,
Yeah, there's not
right?
really a rate sheet. There's just a rate, basically.
Yeah, yeah, yeah. There's not. Yeah, I mean, it's there. Technically, it's there, but it doesn't really benefit you because if you do try to buy it down, it's prohibitive expenses on those two. But on the closing cost one, I do see somewhat options, but then again, the cost is so much higher. I could see why they may only charge a quarter point or zero point 0.3 points for every 0.125 buy down. But they're already charging you up front. Just walking through the door, you're paying 2.272 points on that one. They already got the money from you, so they're like,
Yeah.
sure, we'll give
I
you a
think
little bit lower.
that's more for the MLOs who like to structure it borrower paid comp and want to get their comp covered with some funds, so it just looks prettier. But
Yeah,
I don't think there's much benefit really.
absolutely. The real benefit here is going to be with the repayable or the forgivable options, which are two very good options. And again, I repeat, lender paid options does not increase the closing costs of your borrowers like some of the other national DPA options that are out there that require you to go borrower paid and limit the compensation also. One other thing that I wanted to note in this program that's pretty cool, excuse me, they do allow manufactured homes, okay, and they do allow 2 unit properties, not a 3 or 4 unit, but you can buy a 2 unit property with this program. The only difference is there is a loan level price adjustment of 1.1% in loan discount to the cost in order to be able to finance a manufactured home or a 2 unit property. So it's cool. You can't get a 3 or 4 unit, but you can get the 2 unit and do a pretty good house hack there.
All right. I
Okay, it
think we
looks like.
we
Oh,
got one question here. Let me take you off your presentation off. And someone's, I guess, asking about gifts. Can the 3.5 DPA or 3 to 5 closing cost assistance be gifted? You can. I mean, it's an FHA program. You can include gifts in FHA programs. So this is a gift, right? Down payment assistance is just coded as a gift on your loan application. It's just a gift from the government, whatever agency, the government agency that's operating this is.
Yeah, correct.
So it's technically a gift from the government, right? Whether it's repayable or not. But yes, you can add another gift from a family member or whatever your applicable gift is. I think is that
Correct. Yeah, there are no. I mean, it's only going to boil down to depending which program you're using, because the closing cost assistance program does have a minimum 3.5% of the purchase price contribution from the borrower to the transaction, whereas the repayable and the forgivable option do not. So then in those, you would have more flexibility to apply
if you
a
needed
gift.
to use the full 3.5 for a gift, you're saying.
Well, right. Not so much the gift. I mean, the 3.5, you're going to get 3.5%. You're going to get from the down payment assistance is the down payment assistance. I'm talking about if the borrower needs an additional gift from somewhere for the transaction. This program doesn't have a minimum monetary contribution from the borrower like the closing cost assistance does.
So that's what I'm saying. So they have to give to 3.5 of their own. They cannot have a gift for any of that.
On the closing cost assistance part, but not on the DPA part.
Yep.
Not on the DPA option.
On the regular DPA option,
yeah,
they can, like a regular FHA.
Yep.
Alrighty. I think
okay.
That's it.
Great stuff. All right. Well, remember we do this every Tuesday and Wednesday night at 7 p.m. Eastern. So feel free to tune in. Next week we'll be going over some different topics. So thank you everybody for tuning in. Thank you, Nick. Thank you, Jose, for the presentation. And we'll see you all next week on Tuesday, 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Everyone take care.
Thanks, everybody.
Thank you, everybody. Have a great night.